So good evening, ladies and gentlemen. What I'm going to do now is take you through NWF, both the business that we've got, the markets that we're in, and also the development strategy for the group. The thing we have in common, all our three businesses, is trucks. So we're distributing feed, food and fuel across the UK on a daily basis. And the thing in common our businesses have is they're in quite basic industries. So these are industries which are very much linked to the population growth that we have in the UK. The businesses, the markets we're in don't go down in a recession, but nor do they really go up in a recovery. So to develop the group, what we at NWF need to do is to implement specific initiatives, both organically and inorganically, to develop the group further. Just by way of background, some of the key data on the group. Actually, we're established in 1871, so quite an old group, originally based up in Cheshire. We listed on the AIM market in 1995, so we've been on the markets for a long time. And just to give you a flavour, my background is actually in fully listed businesses, and in moving to NWF 10 years ago, positively I couldn't really see the difference in terms of corporate governance, how we operate. We've got a very chunky annual report, all the disclosures are quite significant. So that should give lots of investors confidence in the business going forward. Some of the data, the market cap today stands at just over 80 million. The revenue is quite a high number, so just over £500 million of revenue. And a large part of that is because we distribute oil. So the price of oil is quite high, and I'll take you through some of the metrics on that shortly. The other key thing to give us confidence and enable us to sleep at night is we've got a lot of asset backing. So you can see the gross assets there, 138 million. That gives us the benefit of also a low-cost source of funding when we're turning to the banks for access. The three businesses, feeds, food and fuel, actually perform in different dimensions. So most of the revenue is in fuel. Commonly, the profits are broadly similar between the three divisions, and most of the assets are actually deployed in the food division, and you'll see why in a few minutes. Most of our sales are in the UK, and in fact what I've put on the map here is the location of our site. So we're across the UK, a national player. Headline profit before tax, 8.5 million last year. The dividend that we pay, we've got a progressive dividend policy, and that yields on today's share price about 3.6%. And there are 900 other employees in the group as well as myself. So that's where we sit at the moment. I've also put this picture up. This is our main operating site. This is in Wardle in Cheshire. To give you a flavour, it's junction 16 of the M6, sort of 2/3 of the way up to Manchester. So part of what we have is actually a property play because we own the asset, so we own the house. It's on our books and valued at £25 million. What we own is basically what is concreted, and that site is fully utilised and deployed. We do have the opportunity to expand the site. There's planning adjacent to our area, but in reality, it's probably about as big as we want to get in this single location. So, 55 acres is fully utilised at the present time. These are the results that we came out with in August. Our year end is May. So this is to May 2017. So the revenue was actually up 19%. Now that was positive, and that shows increased activity levels in each of our three businesses. The key number that we always talk about, and I think you'll see most chief execs talk about, is the PBT. So the headline PBT was up 2.4% to 8.5 million. Not a huge increase, but positively, really positively, it was in line with market expectations. And a good thing for NWF, a solid, stable part of our business, is we've actually been in line with expectations for the last 11 reporting periods. So really positively, we're doing what we say we'll do. And clearly what, like all companies, want to do is just a bit quicker and just a bit better. So we're ambitious, but pleased with the result. In point of fact, that converted into a record earnings per share of 14 pence a share. Net debt, we had 13 million at the year end. We actually have a £65 million facility with RBS, but critically that 13 million represents 1 times EBITDA, so at a comfortable level. And we actually invested over 5 million in developing the group in the year, and in spite of that, debt only went up 3.1 because we're generating a good level of cash. And just to give you a flavour, the board is comfortable with debt in the range of 1 to 2 times EBITDA. So we see it as a good way of utilising our balance sheet, but we don't want to gear up the group too dramatically. The dividend's important, that's part of the mix to generate total shareholder return. And the dividend is actually being increased by about 5% in 9 of the last 10 years. And as we said, that gives a yield around about 3.6% at the current share price. Now dive into the businesses to try and sort of bring it to life as to what we do. So when we talk about feed, what we mean is animal feed, and a bit more specifically than that, we mean ruminant animal feed. And a ruminant is an animal with multiple stomachs. So that's basically cattle and sheep. And 75% of all our feed goes to dairy cows. The reason we like feeding a dairy cow is she's fed 52 weeks of the year, and her performance is measured twice or 3 times a day when she's milked. So it's a bit like I use the analogy of the dairy cow as like an athlete. And what we've got are nutritionists who are providing expert advice to that dairy cow as to how to maximise and optimise her performance. So this is George Franks, who's one of our 40 trained nutritionists. So George went to agricultural college and then has been trained in nutrition. And what we do on a dairy farm is, if you go onto a farm, you'll see a clamp, which is the tarpaulin with the tyres on top. And under that will be grass silage or maize silage. And we actually take about 8,000 silage samples a year from all our farming customers. We take them into our lab and we analyse that for nutrition. And then what we do is we've come up with a feed which will complement that forage and optimise the performance of the dairy herd. So it's all made of vegetable products, so it's things like soya, rape meal, wheat, molasses and palm kernel. And what George is doing is he will advise the farmer on the diet, potentially even for the individual cow, or certainly for the small subset of the herd. And at NWF, we're working with typically the larger dairy farmers who are specialists. So this isn't someone who's got 30 or 40 cows and some holiday lets and some other things. We're working with over 4,000 dairy farmers where really dairy is what they do. And our average farm will have 190 dairy cows. The typical UK farm, for what it's worth, will have about 150. So we're slightly up the scale in terms of size. So we're providing advice, and that's what we're doing, but we don't charge for George as a consultant. When you buy the feed from us, you get George or Georgina for free. And feed costs about £250 a tonne today on average. And we're producing 589,000 tonnes. So if you do the maths, and you see some data later, we're feeding 1 in 6 dairy cows in Great Britain. Right the way from Ayr up in Scotland, all the way down the west coast, where the rain falls, the grass grows and the ruminant animal lives, right the way down into Devon and Cornwall. We do supply feed for beef and sheep, but that's a smaller percentage of our business. We've got 200 people in the feed division, 40 trucks and 21 trailers, and critically we've got feed mills up in Cumbria, near Carlisle, in Wardle in Cheshire and down in North Devon. So they're in the great locations for where our customers are. In terms of some data on feed, and this is a big stable market, as all our markets are. So first of all, we're supplying mainly dairy farmers. So let's look at milk, and you can see milk has been up to 12.4 billion litres in 2016. Now that was actually a 10-year high, and interestingly, when we produced that amount of milk, the milk price fell. So there's a bit of sort of basic and supply and demand. So it has come back a little bit in the last year to 11.8 billion litres. And just to give you an insight, half the milk we produce in the UK is liquid milk that we'll consume, and then half goes into dairy products, be it cheese or butter or yogurts or other products. The dairy herd is about 1.9 million cows, and that's in the UK. But critically for us is, what's this feed market? That's the thing for us, and the answer is broadly it's big, it's flat and it's stable. So it's in the range of 4.5 to 5 million tonnes per annum. And if I wind the clock back 5 years earlier, it was. And if I wind the clock forward 5 years, it would be broadly similar. So to say, that gives us confidence that actually the business isn't going to disappear. But it also says if we want to grow the business, we've got to take initiatives to make that happen. And positively we have, because if you wind the clock back, we've got 6 years, back to 2012, 480,000 tonnes, and the year just finished, 589,000 tonnes. And that's been a combination of organic growth, where we've won new customers, but also because we've bought businesses. Part of our strategy is to consolidate this feed market. And you see our market share is now just over 12%, and we're number 2 in the market. Really now just a slide to capture what's our strategy going forward. And you can't see it in detail, but each of these pins on the map actually represents a customer. And we drew this live in July of this year. So you can see it is down the west coast where the rain falls and the grass grows. And what you can see is that our mills are perfectly located in the optimum location for those businesses. So our strategy is to continue to grow. There are 18 other players, big players in the market. So part of our strategy can be through acquisition, to go and acquire those businesses and integrate them into our network. The other thing we can do is we're supplying feed to those 4,500 farmers, and we could provide potentially more products and services to those farmers. Now, we're not going to get into financial products or vets, but certainly in the nutritional area, there's a number of other things we can add into our portfolio to sell to those farmers. So it's consolidate the market and then sell more to our customers. So that's really the strategy that we have going forward in the feed division. Then move on to food. And what I mean by food is it's actually ambient groceries. So products that you'll see if you come into our facility are Thai food tea, Lavazza coffee, Swizzle sweets, pet foods, all sorts of products. So it's ambient, which means it's stored at room temperature. So it's not chilled or frozen. Everything has a sell-by date on, but it's broadly a pretty long sell-by date, 6 months to a year. And within our facility, we've got 100,000 pallet spaces. So it's 800,000 square foot of warehousing. So it's a big facility, as you saw in that earlier photo. And we're the largest player in the northwest of England. The site that we have, this is the largest consolidation centre. And actually, if you look at all the warehousing here, this is where the food is stored. So it's in a racked warehouse environment. And the key to what we're doing is we're the warehousing and distribution arm for food manufacturers and importers. So a good example is Thai food tea. It was actually on the television on BBC Two on a programme, and you saw some of our trucks just at the end of it. So Thai food has a factory on the Wirral, which is about 35 miles away from our facility. We've got 2 trailers like this parked at the end of their production line, and the product is palletised and then put onto our trailer. We'll then charge Thai food something like £100 a trailer to bring that from their factory into our facility. We'll then store it in our warehousing, and we might charge them something like £1.50 per pallet space per week to store it. Then the key to what we're doing with over 200 food customers is what we call consolidation. So we might be taking half a pallet of tea with some coffee, with some tuna, with some Napolina tomatoes, with some Swizzle sweets, and we create a full load. And this is the lowest cost, most environmentally friendly way of distributing groceries around the UK. If I use an example of Napolina tomatoes, so if you ever buy Napolina tomatoes anywhere in the UK, they've come from us. Napolina is actually, obviously, as all tin tomatoes are in the UK, imported from Italy through the port of Liverpool and then into our warehouse. Napolina own their tomatoes. We're not buying and selling the food. We're their warehousing and distribution partner. Tesco, as an example, hold 3.5 days stock. So that's what they do, and they will then order from us today for delivery nationwide tomorrow. So Tesco place an order on us for delivery of tomatoes that we deliver tomorrow. And then we'll replenish those tomatoes with other products and create that full load into the Tesco distribution centre. So it's that consolidation of the different customers' products which is really what works here. Tesco, as an example, will not take any delivery unless it is at a full load. So Tesco, quite often small food manufacturers, will be pointed in our direction to consolidate the loads into them. So we've got quite a lot of people in this business, 460 people, 100 trucks and 229 trailers, and we're distributing about 100 loads a day. And if you go on the motorways, Bowie is the brand that we have in this facility. And what you'll see is you'll see that name now. As you go up and down the motorways, wherever you are in the UK, you will see that. And they're out there delivering on a 24/7 basis across the UK. And what we have in this business are contracts with big food manufacturers. Many of them are actually bigger than ourselves. So Prince's Foods, one of our larger customers, actually turns over 2 billion. And we've got a contract with them of 2.5 years, and it's detailing all the requirements that we have to make. So we make a good return in this business because we're full, we're efficient and low cost, but provide a good level of service. Interestingly, we had an incredibly busy September. As the schools went back, the weather was a bit cooler and the demand for ambient groceries picked up. So we're doing about 110 loads each day in September. It's calmed down a bit to more normal levels now in October. We also have a packing room. So if you want to do a buy one, get one free or a gondola end display, we'll do that for you. If you go into Morrison's, Asda, Tesco or Sainsbury's, currently you'll see Swizzles displays with Halloween sweets in there. So 99p for a pack of sweets that you can get to sort of give to the trick or treaters. And we've actually assembled all of those and delivered them direct to store. So added value work that we've done rather than having to be done in the factory. So that's business number 2. In terms of development, There's two things. It's first of all about optimizing what we have in that facility. So this is an ad that recently appeared in The Grocer, and we're constantly looking to optimize the customers that we have, because the fixed asset for us is that 100,000 pallet spaces. So if we have customers where the stock turns frequently and they maybe need some repacking work and a complex distribution, more revenue and therefore more margin can be attracted. If it's just something like water, which is stored and kept there until it goes warm, and then actually it's only delivered in full loads, the margins are quite low. So it's all about optimization and refinement. The other thing we're investing in is a pallet business. And there's a market which is growing quite significantly, which is the pallet networks. So there are people like Pallet Line, Pallet Ways, Pallet Force, and this is a market which is growing about 10% each year, because more and more small distribution is happening. And Pallet Line, as an example, take product from manufacturers and put it into all the Amazon depots. If you want a pallet of paperwork, for example, from here, going up to Manchester, a little truck like this will appear on the street. You'll pop your pallet on that, and it'll go through a central hub in Birmingham and then on to the northwest. And we've looked at a number of businesses in this space that make a good return, are growing, and are potentially for sale. But it's a business we don't really understand. So we set up Pallet Line Cheshire about 18 months ago to really get to understand how this business works, to see how we can develop it further. We looked, for example, to expand potentially into Reading this year, but then we looked at the geography and the maths, and take it from me, delivering into West London doesn't really make sense for anybody. It's just so difficult and so expensive. So we turned that one down, but we continue to look at others. And then thirdly, onto fuel. We're actually the third largest fuel distributor in the UK. So we distributed last year over 500 million litres, so 500 million litres of fuel. And typically what we've got, they're not huge pictures here, but you can see a tanker here. We've got 100 tankers in 19 fuel depots across the UK. So we're distributing from those fuel depots in at about a 30-mile radius. We've got depots in Bangor in North Wales, across to Boston, down to Newmarket, down into Kent, Southampton, and across into South Wales. And each of those depots works in about a 30-mile radius. 75% of the fuel will be things like road diesel and gas oil to commercial customers, but will also supply to domestic customers. So there are 1.4 million homes in the UK which actually use oil to heat. I do in my house, so I live in the countryside, there's a tank in my garden, and 3 or 4 times a year a tanker will come and fill up that tank. Interestingly, it's by far the lowest cost of home heating in the UK today. It's about 20% cheaper than the best direct debit online natural gas deal you can get because the price of oil has fallen. So that's the business that we have here, and this business has grown by acquisition. So most of the depots we've acquired over time. There are 150 players smaller than us, so it's still an incredibly fragmented market, so there's still an opportunity for further development. But again, like with the feeds one, I've just put on our development over time here. So again, back to 2012, and you can see the business has grown. So 414 million litres in 2012, and through organic growth and through acquisitions, that's now grown to 513 million litres today. The key thing is actually in fuel, all we're trying to do, and it doesn't sound like much, is make just under a penny a litre. So that's all we're trying to achieve, and we can try and do that whether the oil price is $130 a barrel or $28 a barrel. We buy on the spot market and we sell on the spot market. And the key thing to remember in fuel is half of the revenue in fuel is duty. So when we're selling it where it is 70 odd pence, 35 pence of that is actually duty to the revenue. And if we make our 0.9 pence, which we did last year, that's a fantastic return on capital. That return on capital is over 40%. So a very strong business. The business does do slightly better when it's cold because we sell heating oil, but during the summer and right now we'll be selling a lot more road diesel and gas oil to utilise that tanker fleet. What I've done on this map is shown where those 19 depots are, and also realistically, it's me on PowerPoint, so it's not perfectly accurate, is where we're delivering to, that sort of 30-mile radius of each of the depots. And you can view this two ways. It depends if you're a glass half full person or glass half empty. It's either a great national network or there's huge opportunities for expansion. And what we said in here is we can expand. Remember, there's 150 players smaller than us, and there are those opportunities. So the key thing is twofold. First of all, which business fits in with us? And critically, how do we integrate them? And the way we operate is the depot manager is quite important. So if I go to Yate, just north of Bristol, Sam's the depot manager there. He's 28 years old. He's been trained by us and he's running a £30 million business. So it's quite key that we have the right managers trained up and able to work. So we've got 5 trainees at the moment who are ready to take on depots. So as they come through, we can then integrate businesses effectively. In terms of expansion though, we're saying it'll be within Great Britain. One thing that we're not doing is looking at anything in Ireland, but we have been to Inverness and we have been down into Plymouth. So we are looking at these areas. And the model that we have of integration is the front end and the brand at the local level will keep the same as it was. So if you're used to ringing Eveson's up, same phone number, same phone call, you'll get the service. What we integrate are what we call the back office functions. So finance, IT, purchasing, those will be centralised and done in a much lower cost way. So the opportunity is really to expand the network through acquisitions, albeit we have got a couple of organic starts. So in Kent and down in Brighton, those are new startups that we've done. So we had a good sales manager, good trainee that we could put in there with a few tankers. And they've started to build depots from scratch, which is also a way that we can expand. But then look at the group. So lots of activity in those businesses. And how does it work? And this is we'll go again, 6-year track record. So you can see that's the PBT, the key number, and how it's moved forward over that period. Now, 2013 was a very strong year. You probably don't remember, but that was when winter lasted through to May, and sheep were dying on the hillside because it was so cold and they needed feeding. So we made 8.5 million, actually the same as we made in 2017. But if you do a bit of sort of smoothing, you say actually what we've got is steady progression of profits. It's not dramatic, it's not huge, but it's steady, comfortable, safe development. And the reason we've got that is very much because we've got a diversified source of earnings. We've got the 3 businesses in the 3 markets, and therefore what we can have is some challenges in one of the businesses being offset by the other 2. And therefore, because we have 3 divisions, that diversification reduces the risk in terms of that earnings progression, and therefore we get stability. So whilst this is a reasonably good track record, and over that period, the critical thing is we generated £25 million worth of free cash. It's sort of necessary but not sufficient. We want to do more, we want to grow faster, but it is a track record we're proud of. And the whole thing with NWF is to get across that we're robust, reliable, safe, secure, but ambitious. So you can't play for a score draw, that doesn't happen. We do want to win, we do want to grow, but we're pleased with what we've achieved thus far. In terms of what we're trying to do is we're trying to, I think as most companies, deliver on total shareholder return. So the bits that are within our control is we can generate profit, we can convert that, and we've got a good track record of generating at least 100% of our profit into cash, and then the net result is we can pay a dividend. Then the markets, frankly, will determine what our share price is as a consequence. As I say, we've increased the dividend in 9 of the last 10 years by about 5%. A couple more slides, last but one. This is the sort of the elevator pitch that the PR people would tell you to make in terms of what's the simple reason why pick NWF. And the first thing we'll highlight is a strong management team. And I don't mean at the group level necessarily, I mean within the businesses we've got real in-depth experience. So you saw George, who's one of our nutritionists. If I go into our feed business, we've got an entire team who've spent their whole careers focused on providing nutrition to ruminant animals. So they work on farm, they really know what happens. So if the weather's cold, if there's disease, if there's anything, they know how to optimize performance and how to maximize the business. And the same in the other 2 divisions. So in fuels, whether the price of oil is $140 a barrel or it's falling or there's strikes or anything else, a team which absolutely knows how to optimize the business in those conditions. And then in the food business, Keith and his team have spent their entire careers working with big food manufacturers and the supermarkets. So they know how to operate. And clearly in that market, when the supermarkets say jump, most of the time you go how high and you jump, you follow their course. But to give you one insight, last year with haulage in that business, we contract directly with Tesco. And we had some loss-making loads going to the southeast. So we turned around to Tesco and said, actually, we need an 18% price increase. And they said, hang on guys, you know what happens? We said, yep, we know what happens. So we got delisted delivering those loads, and those got handed over to another distributor, because that's what happens. If you go to Tesco for a price increase, you're delisted. That's what happened. You might remember Marmite in the last couple of years. and then go back 5 years ago and you couldn't buy Hovis because they went for a price increase. So in this instance, we were delisted, we knew that would happen, and Stobart and others were given the haulage for those lanes. They then failed to deliver because we knew it was almost impossible at the price levels that they were given. And 1 month after the business was taken from us, it was given back to us with the 18% price increase. So that's just an example where, because that business is very close to Tesco and Morrison's and Aldi and others, they know how to operate. So it's that in-depth experience in each of our markets which is quite key. What we then have is a very small corporate centre. There's basically 5 of us at the centre who understand the businesses, can help support, drive and challenge the management team. And then critically, when we're looking at how we can develop and grow the group, that's where we're much more involved. The asset backing, so 138 million of assets. What does that do? Well, it helps me sleep at nights, but it also gives us a low-cost source of funding. So we've got a £65 million facility, and we pay 1.25% over base. Whatever the base rate is, if it changes the next week or so, but 1.25% on that facility is a very cost-effective source of funding. We focus on returns, we generate cash. If we don't find things to spend money on in terms of development capital, net, we'll generate 2 to 3 million pounds worth of cash a year. So that's always the key to businesses like ours. Solid performance, cash generative. The consequence is therefore we can grow the dividend. So the final slide before questions, and this is just really relating to the year that we've been and also the current trading. We've got revenue growth in each of our businesses because there's more activity levels happening. And we've seen that. We released a statement to our AGM 3 weeks ago, and that's continued into the new financial year. The diversified business model works. And we've also in the last year completed some strategic investment in our feed mills. That was part of what we've been up to in the last 18 months. Acquisitions are doing what they said they do. The board has changed a little. Chairman Mark Hudson retired after 10 years on post, so now Philip Acton is our chairman. He was the Chief Financial Officer of Genus plc, a FTSE 250 agri-business in genetics, so he brings experience to the board. We've also been told to put up Brexit as a point of comment, and the only point we say on that is there's been no impact on the demand for our products and services to date. So we're not eating more or less or using less fuel or less feed as a consequence. What we have seen though is when sterling devalued in the autumn, actually commodities increased in price, particularly feed commodities, and therefore we've passed those through as price increases. So just out of interest in feed, we've passed on about 20% price increases in the last year, and clearly the milk price has gone up as well. So we can see the input cost inflation coming through the economy, and we continue to monitor what happens in the world markets. And what we said at the time of our AGM, still clearly the case because we haven't said anything subsequently, is we're trading in line with expectations. And those expectations are further progression in that profit before tax, sort of along the line that I showed earlier, and also net debt coming down as a consequence of converting that profit into cash. In the pack as well, you'll see lots of other slides which have our share register, analyst expectations and other things, but happy to take any questions now that you may have.
Very impressive revenue growth in the last results, but profits growth was a lot more pedestrian. There doesn't seem to be much correlation between substantially growing your revenues and doing much to the bottom line. What's the reason for that?
Yeah, the key one is actually to look at is always the bottom line growth and the cash conversion. The revenue is actually up 90 million. Of that 90 million, half of it was about commodity prices. So those commodity prices increase, they simply get passed through. So the revenue line is a little bit of unlike most companies, revenue for NWF isn't a great indicator. So as an example, if the price of oil drops by 20%, our group revenue will drop by 20%, but it doesn't mean that our profitability will dip. Again, we're looking to make about 0.9 pence a litre in selling oil, and on feed we're looking to make gross about £60 a tonne, and that's whether the price is high or low. So the revenue is a little bit misleading. It's the profit number which is the one to focus on.
Hi there. Just following on from that, it looks like feeds had quite a big drop in operating profits between 2016 and 2017. Is that Brexit related, or can you just talk?
No, that wasn't Brexit related. Two key factors. First of all, the milk price. So 75% of our sales go to dairy farmers, and at the start of the financial year last year, the milk price was at a record low. So I showed you the one where we produced a lot of milk. the consequence of that, or one of the consequences of that, the milk price fell to 20 pence a litre. And the average cost of production for a British farmer is about 25 pence. So it was below the cost of production. So there was real trauma at the start of our financial year. And it was seen because actually near us there were cows taken into the supermarkets, and we were considering, or farmers were considering, whether they're going to sort of pour milk down the drains and pick at the supermarkets. So we had really tough conditions in the market. It doesn't mean people fed less, but it meant the farmers were desperately trying to reduce the price of feed, and that squeezed margins. So that was at the start of the year. So tough first half, the second half recovered. There was some impact also from the change in exchange rates, because those increasing commodities came through during the winter when most farmers would have a fixed price for the winter period. So there was some margin squeeze. Positively, that's recovered and unwound by the year end. And in the numbers last year, you can see 1.5 million was the profit in feeds. The analysts would have feeds down to do about 3 million in the current year. And clearly we're sort of comfortable with that at this stage. So we can see that recovery.
Just one more question, if I may. Could you just talk a bit about how you see, or what the impacts in terms of subsidies are on the feed industry, and how that might change with Brexit going into next year, perhaps?
Yeah, so if you use the average farmer, if there is such a beast, the average farmer in the UK gets £40,000 subsidy from the single farm payment, and it's broadly linked to the land that they have. What the UK government has said is that will remain unchanged until 2020, whatever happens with Brexit. So till 2020, that will remain. You then go, well, what happens beyond that? And Michael Gove has spoken a few times, and what he has said is he's really keen on the environment. So he'd prefer it to be a subsidy down to what environmental support farmers deliver rather than the land they have. So whether they leave some land fallow or look after ditches or woodland or those other things. If that's the case, the farmers will adjust their behaviour to suit that subsidy. The view that we would have is actually over time that subsidy will decline. Because what the UK government isn't keen on subsidies, and there was another conference I was at and someone saying, why do we subsidise farmers? Why don't we subsidise teachers or nurses or other groups in the community? This is very much a European initiative. So what I do think is those subsidies over time will disappear. But actually what will happen in its place, you'll get price inflation that will simply replace it. And if it's done over time and in a managed, well communicated way, I don't think there'll be a significant impact on farmers. It'll just be their income will come from another route.
You mentioned you try and make about 0.9 pence per litre on the fuel.
Yeah.
And if I remember, about £50 a tonne on the food. On the feed. Can you give some indication of any price exposure you have on the underlyings, or are you just making a fixed turn for bringing the things from A to B?
In terms of fuel, to give you a flavour, so we're buying fuel for, if we're buying diesel today, we paid about 92 pence. What we're looking to do on that is make about 4 pence gross margin, and then with all our distribution costs and other costs, it gets down to about 0.9. And that pence per litre will be fixed, whether diesel was 60 pence a litre or 120 pence a litre, that's fixed. So our return on sales will vary, but our return on capital will be consistent. In feeds,
cost plus, effectively.
Sorry?
It's cost plus.
Fixed plus bit, depending on the base can vary. On feeds, it's slightly different. The £60 a tonne I gave you is gross margin, and the net margin you can calculate down to about £3 a tonne in terms of what we're doing. And again, that will be independent of what the price of the feed commodity is. We're sort of passing that through.
So if you're passing all of that through, why are you bothering to buy it in the first place and sell it? Why not just take a fee for the service you're providing?
You could do. Well, the reality is farmers don't want to buy the commodities and don't want the exposure. In some of the markets that does happen. So if you go into some of the poultry markets, some of the big poultry customers will actually buy the feed. So for example, when Bernard Matthews got into trouble, actually Tesco and Asda had some exposure because they bought the feed. With dairy, they're small farmers, there's 10,000 of them, and they don't want to be involved in buying commodities. They'd much prefer us as a feed company to buy the commodities, make the feed, and then sell it to them for a fixed price.
So what are the real drivers of profitability if it's not revenue growth in your business?
Well, it's volume growth. So volume equals activity, and it's volume growth. The revenue itself is a consequence of volume, but also about those commodity prices. So it's about driving volume growth, but it's also about doing it efficiently. A common theme across our group is utilisation of assets and a high level of customer service. So we've got 47 trucks So we're manic about trying to get 2.7 loads per truck per day. We're also really focused on service. So if you order your feed today, we'll deliver it in day 2. If you want it tomorrow, we can do that. We'll make a small charge. So high level of service, high level of asset utilization. That's true across all 3 divisions. Okay.
I just want to question you about your strategy of trying to grow the feed business. I mean, it looks to make a, if cost of capital is, high single digits, the real cost of capital is, and it's making 4.2 last year, 6.9 the year before. Correct. It's barely making really any return at all. Yet you've got a great business in fuels making 45% and an average business making 11 in food. So why not, if you're trying to increase shareholder return, isn't the best thing to do dramatically grow the fuel business and get out of feed?
In a simplistic way, absolutely right from those numbers, correct. There's 2 constraints to that. One positive, one negative. A positive is actually the return on capital in feed is a low point here. If you look at historically, we have been in the 12 to 13%. So it's been through the low milk price. It's also been through a period of investment and reorganisation of the businesses. We've built new factories. So we hope to get that back into that good double-digit number so it makes sense. In fuel, we do want to grow that business. The returns are great, but we'll grow it at the rate at which we're capable of integrating it. So, we could look at a business today which have 10 depots, we could acquire it, but it wouldn't be able to be run effectively because we don't necessarily have the team to go in there and run it. So we've got a constant training school of bringing up trainee managers. When we've got them, then we can go and acquire the businesses. So, but you're right, it's about growing the businesses and focusing on those returns. Okay, thank you.